Good afternoon, everybody. I guess we're still coming back in. My name is Scott Greiper. I'm the president and founder of Viridian Capital Advisors, and happy to be back at the third annual conference that the firm has put on. We've been part of it since Frank and Scott started this event a few years ago. In fact, I think we put on with Burns the first ever cannabis private equity conference in the great state of Massachusetts a few years ago, and that's my favorite part about being in this industry is you get a chance to do really cool first. So happy to be back, and thank you to Frank and Scott and the whole team. So this is my usual song and dance that I kind of go around the country, New York and other places, talking about the flow of capital in the cannabis industry. Guys, can we jump to the first of the Veridian slides, please? I have to remind. Well, you don't have to. You could be nice about it and just remind me of that. There you go. So for those of you who know us or don't know us, Veridian Capital is an investment bank, M&A, and advisory practice located in New York City. Assuming there's no FINRA or SEC representatives here, we were the first investment bank to launch our practice in 2014. FINRA doesn't let you say that, so if they are here, I'm pretty screwed. But if they're not here, we're good to say that. We have been financing companies across the world, from financing Israel's largest medical grower, Israel's largest biotech company, to the 7th license owner in New York, which just got sold, the 3rd license owner in Florida, which was sold to Ianthus, and on and on and on. We act as advisors to our clients in addition to bankers, so we build boards, we build teams, we build models. And when we're ready, we go out and bring our investors in, or we'll sell your company to a strategic acquirer. So the last year when I'll end with, what I'll be talking about here is referenced at the bottom, the Veridian Cannabis Deal Tracker. I'm hoping all of you guys are subscribers to this. It's free. So you could just go on our website. We put it out every week. And it is the only database of its kind in the world. We're now 5 years into this, that tracks all of the capital markets transactions in the industry. Invested capital, public and private, M&A, public and private, US, Canada, Israel, South America, a little bit in Europe. We've tracked about $50 billion worth of transactions. And so this is what I get asked sort of to bring to an audience like this is, where's the money going or not? Who are the investors making the bets or not? By the way, prior to a few months ago, there was not or not. Well, there's an or not today, unfortunately. Who are the acquirers? What are they buying? What are they paying? So to jump into things, guys, and this is a picture I never thought I would include in a cannabis-oriented seminar, but there's the man, Mr. Darwin. And I put him up there because I was trying to think of a way to represent the fact that for the first time in the sort of uninterrupted growth of this industry, legalization, investment, M&A, IPOs, RTOs, capital markets, we're actually seeing a retrenchment, and quite a significant one. And it is truly becoming survival of the fittest because the first time in this industry, not that we've had an institutional capital markets, but the capital has been there. You'd have to go chase it a little bit and try to find it a little bit, or you call us or somebody else, but the capital has been there. The acquirers have been there, and that has disintegrated. And I don't use that word lightly, but it has disintegrated. So the public markets are down. You all know that. It's been a severe retrenchment and correction. And we're just hoping we're flattening out and finding a base and finding a bottom in the public capital markets because it's been nasty. When, Kush through Jefferies, which does great work in this space, closes at $270 on one day and the deal is priced at $1.70 the next day, the market's speaking. And the market's telling you that at the valuations they were looking at up in Canada for the last 3.5 years don't matter anymore. So the cliche of fundamentals matter is true, And I hope it's someday that the fundamentals of the industry catch up to these drastically reduced valuations, because we're almost in an inverted yield curve. Public market valuations to us now are more attractive or as equally as attractive as private market valuations, and that's rare. That tells you how far the public markets have fallen. So cannabis stocks have come down, investment activity is down. For the first time in us tracking the capital markets of the industry for 5 years, for the first time in the third quarter, M&A activity was down. And for those of you who subscribe to the tracker, you should get it in about an hour. There was one M&A deal done last week. One. We've not seen that before. So it's really had this decline in valuations and capital markets and liquidity is really affecting the transactional side of the business. We've seen deals that are getting broken up that were announced. MedMen PharmaCann is the sort of, poster child for that. We're seeing the Canadian LPs start to unwind assets in Jamaica and Bolivia and Africa. When they went on this torrid pace of, we're going to buy everything, because our market cap is not justified by our business opportunity in our home country of Canada. So if we keep announcing these deals everywhere, even though they're contingent upon the sunspots turning, the markets will reward us, and did, with increasing valuation for their stocks. That's done. So you got to return to what you do best and what you're being paid to do. So we're in survival of the fittest. So here are some of the facts and figures. I hope you guys can see this. The guys at Burns will make this available. So here's Q1 of 2019, right? $3.8 billion raised. We were down quarter over quarter because that compared to the Constellation investment in Canopy in Q4 of 18. A little bit of an unfair comparison. But if you look at the middle here, we were down in terms of number of raises on a year over year and a quarter over quarter basis. That's the first time we've seen that in the history of the tracker. So we started to see the beginnings of the decrease in public market valuations impacting the dynamic, the liquidity of the capital investment side on the negative. What we did start to see positively is on the lower right here, which is that for the first time in the history of the Viridian Cannabis Deal Tracker, more invested capital came into the US than Canada. And hooray for that. Do I have a hooray, a hallelujah, a clap for all of us Americans playing in this market? Thank you. Nothing against Canada. It was a bastion of exit opportunity for US companies, but this is the market, this is innovation, this is R&D. We have the best speculative trading market in the world on NASDAQ. Thankfully, it's coming back to the US. Q2 kind of stabilized a little bit in terms of the trends of number of transactions, dollar volume of transactions year over year, quarter over quarter. And thank God, again, the US was the target for investors in the second quarter. The third quarter, as I say, we started to see some real reduction. Number of deals, total consideration of deals, 146 raises in Q3. That was down from 190 in Q2. This is the first time really we saw the impact of the collapse in the public markets affecting the investor. But where we're really seeing that is in the M&A side, which has been, as you guys know, a torrid pace of a massive land grab for years. Years. Now, whether there was economic justification to a lot of these deals, you can make your own decisions about that. But it's just been a massive land grab. The MSOs buying licenses, the LPs buying anything in front of them, up-and-coming MSOs trying to get the second, third, and fourth licenses. It's been a torrid pace, as you can see in Q1 here. This is Q1 19, and I'm trying to fly through this so we can get to our panelists, guys. But again, the good change in Q1, for the first time in the history of us tracking this stuff, there were more acquisitions done in the US than not. So not only is the investor looking down here, so is the acquirer. It's a good thing to be an owner of a company in that state, in that dynamic. Second quarter, kind of the same thing. And in the third quarter, the whammy hit. So I just told you last month, for those of you who are getting the deal tracker in a couple hours, there was one M&A deal. We've never seen that. So in Q3, there were 70 deals announced. In Q2, there were 94, and in Q1, there were 95. So we're down 30% in the third quarter in the number of announced transactions. And the trends quarter over quarter and year over year in terms of number of deals and total aggregate value of the deals was down 16.7% and 36%. So the market is cracking. And when you look at who the typical buyers are, whoops, sorry guys. When you look at the typical buyers who have been the public companies, because it's better to buy with currency than with stock, and the public companies have had richly valued currencies. The number of acquisitions by public companies was 90 last quarter, it was 48 this quarter, and it's going to be down much more significantly this quarter. So this is a challenge now for, and hold that thought, and the going public rate of companies up on the CSE through the reverse merger, the reverse takeover, is coming to a grinding halt. 5 deals last quarter. So you're a private entrepreneur, you're running a private business, and you've got, for the last 3 years, incredibly strong visibility to the exit, which is so unusual for an early stage technology marketplace, which is kind of what we are. It's not usual. The exit's usually 3, 4, 5 years down the road. Here the exit's been, it's going to take me 4 months, I'm going to RTO up on the CSE, or I'm selling to Harvest or Columbia Care or MedMen or the exit's been right there. We pitch this to the investors all the time, that this is not a long-term buy and hold industry. There's a rapid pace of transactional dynamic here where you can pretty much see the exit in a year or 9 months or 18 months, and you've got choice, you've got optionality. The public markets, the M&A markets. That's not true anymore, for at least right now. If it changes, it may change. I'm not quite sure we're ever going back to where we were a year ago. So the challenge now for the operator is, I can't tell my investor that they're getting out. I'm not getting public on the CSE or TSX. I think those markets are tired. And I think they've been tired for a long time. And what Canopy was offering for my type of license in my state and my stage of the business is now 30% of what it was 6 months ago. So it's just, everything has changed. And it's happened very quickly. There's an erosion in consumer confidence. The acquirers are not as well equipped to be good buyers anymore because they're not playing with monopoly money, they're playing with cash. So execution matters, fundamentals matter, governance matters, financial controls matters, balance sheet matters. And I think in the long term, we'd all agree that's a really healthy thing, because the institutional investor has all the reasons in the world not to play in this market, the least of which is federal illegality and money laundering and all that stuff. But with overvaluation, it gives them more reason to say, this is a hyped market. I'm out. And now we're in a strange dynamic where, at Veridian at least, we're focusing much more on public companies because we can get our investors in at price points that rival where we were getting in private companies. And we have liquidity in these portfolio companies. And we have an easier ability to raise cash. And we have more information dissemination of our public company clients, stuff that investors live for. So we're focusing more on public companies now on private companies. You can't ignore the private side. That's where the innovation is. But strange dynamic that the public market valuations are trading at par with the private companies. So in conclusion, we really have reversed a 3.5-year raging bull market in this industry that took valuations, that took liquidity, that took the exit opportunities to, I guess now in retrospect, unsustainable levels. Smart capital is increasingly coming in. I think that the investment rationale in the industry is getting better and better, but now they're much more focused on valuation, structure, security, optionality, outs, governance, protecting their investment more than they were a year or two ago. And we're seeing a lot more debt come into the market. We've been reporting on this for some time. There was debt in the beginning when we came in 14, 15. It was called toxic convertibles. right? I'm going to give you $1.5 million, excuse me, and it's going to be convertible at 20% to your public market, 20% discount to your public market valuation, no floor. So what's the incentive of those guys? More the stock goes down, the cheaper they're in their investment. It's an inverse incentive to what the company's looking for. So that was debt, but it was vulture debt. We're seeing much more sophisticated traditional debt come into the marketplace. And that's a good thing because that means there's actual cash flow to support and service the debt for the companies that have a bit of a more of a tenure of operating history. So, this is my last slide. We have been such a trigger-rich, event-rich industry for 5 years. The spread of legalization in the US. California, the biggest market going rec. Massachusetts, the first East Coast market going rec. New York and Florida, 2 of the largest medical markets legalizing in 16. Canada going rec. Canada bringing in edibles and vapes. It's Jeff Sessions leaving, the visible earth. All of this stuff that's been driving or clarifying or supporting the investment rationale in cannabis. And now we've crashed. And so what's next to lift the investor confidence? What are the triggers driving investment? I put some down here. I'm sure you guys know of others. I think the most important one is the Safe Banking Act. Frank can certainly speak much more eloquently about the effects of that than I can, but it does allow the institutional investor to come in and believe that if they make an investment in a company, that company can get a mortgage, that company can get a credit line, that company might be able to get point-of-sale card acceptance, a regular business that has liquidity beyond issuing dilutive capital, right? Getting it from an FDIC insured bank. The Safe Banking Act is the most critical trigger we need passed in the industry from the investor's perspective. And I don't know about with you guys, I'd love to hear your perception, but I was with a couple of guys 2 weeks ago that were with Mr. McConnell, Senator McConnell in a room, and they came out and said, deal's getting done, it's going through the Senate this year. And I was in the same room with a couple of guys that said, it's not getting done this year, maybe it gets done next year. You don't have the same bipartisan support in the Senate as you did in the House. I don't know, but we desperately need this thing to get passed through the Senate. California, we saw the Governor Newsom a week ago either enact legislation or suggest legislation, somebody's got to bring me up to date, to reverse the draconian effects of 280E on the cash flows of licensed operators. That's a big deal. You guys know all 280E, you get taxed at the gross margin. So no matter how quickly you're growing top line, no matter how sustainably you're growing top line, your free cash flow sucks because it's getting scraped out by the federal government. You're getting taxed at your gross margin. That's just ridiculous. So even though this is a federally legal product, the government's taking its piece of the pie in a big way. Hopefully that gets reversed in the largest state and other states will follow. A couple of others before that. I've been giving this talk lately, and there's somebody on my panel that goes, you sound like the sky is falling, but people are still consuming, and people are still buying, and it's legalizing all over the world, and it's true. The business side of this, as you heard from the other panelists, is still quite healthy in certain pockets. But it's getting much harder to raise capital. It's getting much harder to get the valuations that you want. Companies are going to be doing down rounds. This is happening in the market right now. If you're a buyer, you're in a much better position because you don't have to come with the valuations that you did. And if you're a seller, I think you're in a bit more of a compromised position because your exit options are fewer. So for guys like this that are in the industry that play with the dynamic of transactions, it's actually a very good opportunity because we've always chosen our spots very carefully, and now we have a wider universe in which to choose our spots carefully. So with all of that, let's get to our panelists. Codie Sanchez from Entourage Effect Capital, formerly known as Crest Capital, and Jordan Allen from Reich Brothers Capital. I'll ask them to each to introduce themselves, and I think the obvious question that I think the audience would like to know from you guys is, excuse me, as investors with the backdrop that I just described, how has it changed your approach, your structuring, your valuation analysis, your overall investment approach? How has this changed with the state that we're in the industry right now? So if you could just introduce yourselves first, say a bit about your company, and then we'll get into that.
Great. So my name is Codie Sanchez with Entourage Capital. We're a growth equity, private equity firm in the cannabis space. We've been investing since 2014, so we're certainly feeling our 40 portfolio companies in the mix, feeling some strain here. And we have about $170 million allocated to the industry. We're raising our third fund right now, which is a $150 million fund. Surprisingly, I'll just say one quick thing. Surprisingly, as an investor out there talking to investors and raising capital myself at this moment, institutional investors right now, for the first time ever, are interested in talking to us about this fund. So I think there might be a little bit of a reversion happening because they see that there is an entry point for them to get into these companies at low valuations. We'll see if it pans out, but we're definitely having an easier time raising than I thought we would, given the market.
My name's Jordan Allen. Our company's called Reich Brothers Finance, and we have a real estate and machinery equipment finance business. We've been doing it in non-cannabis sectors for 6 or 7 years, and we last year started financing companies in the cannabis space. We actually do that under a different banner. We call that Landrace Financial. Landrace is the virgin strain of cannabis, as you may know. So we focus on assets. We focus on real estate, machinery, equipment. We do give some credit to licenses. It certainly is an asset. We generally stay away from inventory and receivables, but we essentially focus on hard assets. We've done deals from $4 million to $50 million. Actually, 50 was in a 30 and a 20 different, 2 different pieces. We hold a piece of everything we do, typically 20 to 50%, and then we have a syndication facility where we partner with a number of other lenders. There are not many of us, as you know. Banks cannot provide capital, lend in this space. Generally, certainly the federal, certainly national banks, but in addition, there really is very little private capital for various different reasons, which we can talk about. And so there are very few lenders in the space. We get a lot of calls every week. We're seeing a lot of deal flow. But we like it. We think it's really kind of an interesting space. The sell-off in the equity markets, frankly, has helped us. I think people have kind of come around, and we'll see over the next year or two. We'll see whether there's really a viable debt market that develops in this space. I think there may be. So we like partnering with other people, and we're looking at it allows us to look at more deals on a larger scale.
So if I could follow up on that, Jordan.
Yeah.
Innovative Industrial Properties was the first cannabis IPO in the States, I believe, certainly the first on the New York. Great pedigree of guys who had built up, labs, biotech labs, sold out for a big number. And I think the stock's been cut in half.
Yep.
So you've got a company that only works with medical cannabis operators. That's
Right.
I think how they got approved to go on.
Sure.
You've got a portfolio of yield-producing properties.
Mm-hmm.
Why is that? What's happening in the real estate side of the market that's helping you out as a private lender provider that's crushing IIPR as a public lender provider?
So listen, I think it's a little bit that it just kind of got caught up in the. It was overbought, I think. At one point, I think it was actually the best performing REIT for a long period, certainly for last year, I believe. Or for a period kind of until their sell-off. And it was eventually trading at, I want to say at like a 4% yield. And so I think it's reversed, and so it's currently trading at probably at a price that's a little bit more in line with reality. So I think it was overbought, and it's just kind of reversed.
And I should have positioned it.
Yeah.
I'm asking you to comment on the stock, but is there anything underlying the business of lending to licensed operators in financing real estate that's changed, that's more risky today? Or?
I mean, listen, the pricing's changed. So, when those guys got started, they were doing 17, 18% cap rate deals, and now they're doing 10 and 11. And I heard about one that got priced a couple weeks ago that was below 9. So I think the pricing has come down. Now we'll see whether that reverses. That's relatively, I haven't heard about new deals getting priced on the REIT side in like the last 3 or 4 weeks, when there's, kind of the following, a little bit more damage in the equity market. So I think it's, I think that's probably what you're seeing in the stock price. It probably, the pricing has come in. There's a little bit more competition also. So for a while, IIPR was they actually are the only public company, a public REIT, but there has been a number of private REITs that have raised a good amount of capital. A group out of Atlanta, the Treehouse guys from MedMen, and 1 or 2 others. There's actually a group in Chicago that raised some capital. We looked at the sale-leaseback market. We decided not to participate in that. It's just, frankly, I'm just not smart enough to know if I want to own an asset for 20 years. I just, I'm much better at kind of short-term 3 to 4 year loans. I know I feel much more comfortable with that. But they do have access to capital markets that we don't currently.
So their pricing has come down, which is probably the
Competition increase, pricing's coming down. I think there's a little bit of negative sentiment about the industry. And frankly, I haven't looked recently, but if anybody wants to look and tell me what the yield they're trading at, it's probably trading at a more realistic yield. It was like a 4% yield, which just was crazy.
Got it. Okay, thank you. So Codie, within the realm of, you guys are very experienced investors. You've been here a while. You're now out raising your 3rd fund, I think you said. Mm-hmm. So what is, without breaching confidentiality, what's different about the investor conversation today than when you were out raising 1 or let's say 2, which is more nearer term?
Sure. Well, the world has surely changed. I mean, I seeded this fund myself. I wasn't an investor in 2014. I was in the financial markets. I ran an emerging markets business. So, same sort of fundamentals in a nascent industry, but I didn't even want my face or name publicly associated with, at the time we were called Crest Capital. I was FINRA and SEC registered, and I really wasn't sure it was going to happen to those people who put their name out there. So I have to give props to our founder who actually did that in 2014 when he was out raising. We seeded him with a very small group of investors. So we have a lot of our own money in the deal, which I think is really important. And we really only raised, I think that first fund was $10 million and maybe $10 million in co-investments. It was small. I ran a $3.5 billion business prior to this. And so then this next fund, we ended up closing that fund in about a 6.5 month raise once the full fundraise team was put together. And so it was completely different at that point. I mean, we still don't have any pensions. We don't have any sovereign wealth funds. We don't have the big institutional investors that we would have had in our prior businesses. But they wouldn't take the meeting at all in Fund 1. They thought about taking the meeting, and we got a few meetings for Fund 2. And now Fund 3, we're talking to some of the LPs that, we talked to a pension in Chicago yesterday. We talked to a very large endowment. We talked to a couple names in California that you guys would know. I don't think they're going to invest right now, but they would not take that meeting prior. So it's really like this dichotomy that you have of right now, we sent an email to our portfolio companies showing, do you guys remember in 2008, Sequoia, one of the world's largest venture funds, they sent out a very famous email with a tombstone that read, "Rip Good Times" on it. And they sent out that email, which was really probably fun for all their portfolio companies to get, saying basically, the good times are over. You guys need to watch your balance sheets. You need to be understanding how much cash you have on a daily basis, because if you don't have 12 to 18 months, 1, we're probably not funding you more money, and 2, you're probably going out of business. And so we sent that email out to our investors, replicating Sequoia's, in December of 2018. And then we were at MJ BizCon and gave a keynote, and we put that big thing on the stage. And I remember I got all this pushback, like, you obviously don't see what's happening in the market. Don't you understand this is going to be, a $50 billion, a $300 billion, a $1 trillion market, which I still think is the case. But those valuations were absolutely ridiculous. You cannot go and raise private capital at forward-looking, let's say 10 or 15 times your 2020 potential projections. And people were literally doing that. And so I think institutional investors see that and they see legalization and they're like, okay, we don't have a lot of professionals in the space. And that's not good for cannabis overall. So, unfortunately, I think what some of the Canadian LPs did and what some of us did by not setting our expectations correctly and having really aggressive projections we could never meet is we took an industry that already has a ton of negativity placed upon it because most people see us as cocaine dealers still in the institutional space. And then we showed that we didn't really understand how to run a business and how to value those businesses. So we got to take a little bit of this internally and say, how do we change the industry from the inside out? Because that's the only way we get institutional capital. Now institutions see the valuations coming down and they're like, hey, this is an interesting entry point because when retail investors flee, typically institutional investors come in.
So with all of that being said, yeah, let's give that a round. With all of that being said, it doesn't seem to be that if you've got an institutional group that thinks we're dealing cocaine, whether they could buy in at $10 or $1 is not going to make a shit bit of difference to them. Mm-hmm. So what else has changed for them that is getting you these meetings?
Yeah, well, I mean, this has become a mainstream conversation. All it takes, I was just walking up Abbot Kinney, the famous road in Venice, where you have a huge MedMen located right in the middle of it. And I was sitting with one investor that runs a trust, a private trust, so they don't take any government money. They could invest in something like us without vice clauses. And I said, do me a favor before you start asking me, well, what about federal legalization? Well, what about Trump? Well, the Safe Banking Act isn't going to pass, blah, blah, blah. I said, I want you to watch what happens with every person walking by. And you tell me what is one thing that you noticed that every single person walking by has in common? And so they did it for a little bit, didn't notice anything. And then they kind of started chuckling. And what they noticed is 1 out of 2 people walking by was carrying a little red MedMen bag. And so, I said, it's the Starbucks of today in California. And MedMen's its own thing that I won't get into, but we have to give props to those people that start in the industry because they are normalizing it for us while simultaneously, getting it to the chin a little bit about professionalization. So to answer your question, what's happening is that they're seeing consumers spend money. They're seeing $3 billion in tax revenue come in from cannabis. And they're seeing the fact that everywhere else, we are trading at all-time highs in the public stock markets. The economy is stalling largely. We're seeing manufacturing down. China's less than its 6% number. And where else are you going to get double-digit growth in this environment when the whole world who isn't talking about cannabis is worried about some sort of recessionary item happening? Plus, what happens during a recession to vices? They go up. So institutions aren't dumb, but they're starting to see the fact that it's normalizing and the rest of the world has a more interesting risk-return ratio than it did in 2014.
Okay. So Jordan, you have, over the last 5 years, the cultivation sector of the industry,
Yep.
vertical, raising about or attracting about 65 cents of every invested dollar.
Mm-hmm.
So now you come in with a lending portfolio. So what do you look for? What are the metrics of a company that gets you to write a check?
So for us, we focus on assets. So really that's our kind of our primary focus. Typically, when we have an introductory call, everybody, wants to talk about their great growth projections and their, they send me their fancy deck. And really all I want to say is just send me your list of assets. Like, send me your equipment, send me your real estate. If you have an appraisal, great. If not, kind of send me your budget and cost. And so for us, that's always the first analysis is, do we think that there's the requisite collateral there to even progress on a loan? Once we see that that's the case, and we actually have a couple appraisers that we use that we get kind of a very quick read. And then after that, if we think that there are the requisite assets there, then we'll focus in on everything else around the business. The management team, their capital stack, obviously their business plan, their cash flow needs, et cetera. But for us, it all kind of starts with with the assets. And we're a little bit different. You know, there's definitely, you know, the other guys you'll hear about in the space, Gotham Green and Torian, those guys are a little bit more, call it enterprise level. They kind of start at the top. They're doing converts. We don't do convertibles. We do term loans, and if we get equity, we'll usually take it in the form of warrants. And that's just kind of consistent with how we've been lending across all our different asset classes. We focus on the assets and kind of, you know, follow on from there.
How long have you been lending out money to the industry?
So, so the history of our business is Reich brothers, and there actually are two Reich brothers, and my partners, Jonathan and Adam Reich. They've been in the asset liquidation business for 20 plus years. Kind of a mini Hilco or mini Gordon Brothers for people here in Boston. They don't do retail. They've always done manufacturing and industrial. And it was a portfolio company of a private equity, private debt firm that I was a partner of, Victory Park Capital. And it was my portfolio company. I was on board. I got to know these guys really well. And Adam lives in California and started investing mostly through debt into different cannabis businesses over the last decade. And within Victory Park, we just couldn't do it because all the same reasons that, you know, other private lenders can't. There's SIN provisions in our fund documents, and we have, you know, institutional investors that wouldn't want us to do it. So within Reich, we had built out a hard money lending, essentially a machinery equipment and industrial real estate business to complement the liquidation business. And they both grew nicely, and ultimately they became both, couldn't really keep them under the same roof. They both needed more capital and management. And so we separated those about a year ago. And so I now am partners with Adam and Jonathan in the lending business, and they still own their liquidation business kind of separate with another partner. So we've been, you know, to answer your question, we've been lending in the cannabis space for a year, in other industrial sectors for the last 6 years under Victory Park, and Adam and Jonathan actually go back and have done lending and liquidations in this space for the last 25 years or so. So we have, you know, we have a lot of tribal knowledge on this space.
So Codie, similar question. How has Entourage's investment approach, filters, philosophy changed, not just valuation-wise and metrics that you're judging a business on, but by sector? Have you changed your approach in where you go into and where you won't go into with this recalibration in the market?
Absolutely. I mean, Fund 1 for us, we made all of our money largely on MSOs and cultivation. So that fund has returned 120% of the capital now, and we still have, I don't know, 40% of those portfolio companies at work. So that one's shaken out nicely. But we really, you know, in this industry, it's fascinating because historically, if you're in private equity or venture, the two words you need to know are niche down, right? You really need to be a hyper specialist on whatever your area or sector or industry is, because that's how you get the best deal flow. That's how you actually understand the companies. And so in any other industry besides cannabis, any fund like mine would be hyper focused. And so you get, you know, fintech focused funds that only invest in SaaS fintech models or whatever. But in cannabis, if you did that, you actually didn't do very well over the last couple of years because the industry has evolved so rapidly, as you alluded to. So that first fund was completely MSOs and cultivation. That was smart to do early in the space because that's where a lot of the returns were, and it was sort of this land grab aggregation model as opposed to, as you mentioned, today it's really more focused now on execution finally. So Fund 2 ended up being no cultivation. So we didn't invest in any pure cultivation plays. You know, I even got a really nice email from a cousin of Pablo Escobar in Colombia asking me if I wanted to invest in cultivation there. I passed, if you could imagine. But so we've moved away from the cultivation space because, you know, and I can say it in here and maybe not out in the world, that you don't know too many really wealthy tomato farmers. And our take is largely that cannabis is not too dissimilar from other commodity crops. We'll have some sort of craft segment of the business, but for the most part, the money is not going to be made in cultivation. So we've moved away from that, and now we're focused more on ancillary services, on brands, on tech, and on retail and dispensaries that are intelligent in their growth models and that have 12 to 24 months of capital. We're very focused on capital, and that's helped a lot of our portfolio companies. The bigger thing I think that is a focus going into Fund 3 also is more of the biotech plays. We did well in a couple of those, like Ebu, which we sold to Canopy Growth, for instance. But what happens to cultivators if we achieve biosynthesis, like we think we're going to in the next 2 years, let's say, and all of a sudden we can grow cannabis from algae or from yeast instead of having to have massive indoor greenhouses in Canada for a tropical plant? Doesn't make a ton of sense, really. And so I think that segment of the business is one area we're staying away from. We're not alone in that.
Interesting. All right, folks, we're under 9 minutes, so let's open it up to you guys. You guys have questions? There's not, there you go. Can you stand up and scream so everybody knows?
So, the entrepreneurs in the room walk me through what a good valuation looks like. Let's talk, you said tech, so give me the mechanics behind that. What's attractive?
Yeah, well, I mean, great point first up front, which is my answer is not going to be hugely useful because it's so industry specific.
Or cannabis.
Right, subsector specific inside of cannabis. So it's going to be different for a tech play than a cultivator, than a license aggregator, for instance. But the very first thing I think you should think about is look at the industries outside of cannabis that are aligned and see what valuations are within them. You don't get a cannabis premium anymore. So if you have a cannabis tech company, go and see what a cannabis tech company is trading at today. And then maybe also consider the fact that inside of cannabis in particular, we are also having the ripple effect from these companies like WeWork, Uber, et cetera, who are having massive issues with their IPOs because of the fact that they are not execution focused, they are market share focused. And so if your tech company is actually profitable and you can continue to run, you might be able to put a little valuation premium on it. But I think the most important thing for you to think about is if you're post-revenue, what are your trailing 12 numbers? Let's actually talk about EBITDA.
Let's talk about the majority of the market. Pre-revenue.
Well, yeah, pre-revenue is going to be a tough thing. Get prepared for a little bit of strain there. If you're a pre-revenue tech company, you need to raise from friends and family, and you probably have to go look at what are similar tech companies trading at, and don't use public comparisons, use private ones. And the one thing, and this sucks, I get it, I've been an entrepreneur, I sold a company too. It's never fun fundraising. But if you are reasonable and talk to your leads and you have a real business and experienced team, nobody's really looking to screw you. We just don't want to have to go through down rounds and everything that we were talking about. So just be reasonable in your upfront valuation. Your fundraise is going to be so much easier. And the easiest way to know if you're reasonable is ask your investors who seem actually interested, get a little bit of a consortium on them, give them some valuations that you think are reasonable, but get feedback. Is there anything you would add to that? Or you would add? No?
That's good.
No, I thought that was
Yes, sir.
perfect.
Nope, you? There you go.
Thank you. Yet another stimulating panel. So my question is for Jordan, perhaps. REITs were seen in the last few years or early in the investing side of cannabis as a much more stable or safe way to be involved in cannabis because you were a landlord as opposed to a plant touching business. Is that still the case? And as a follow-up, if that is still the case, do you see that only being beneficial when working with multi-state operators because you have a chance to pump out a bunch of different REITs? Or could there be a place in the market where in states like Maine, where they have a small market geared towards caregivers, you might be able to make a good impact on the community and on the cannabis industry by promoting incubator spaces that a lot of small operators could get into as opposed to just working with one big company?
So, yeah, there's a couple different questions in there. So, is the REITs a good way to play the space? Yeah, listen, I think that that when it started, IIPR, I thought had a really interesting idea. They were able to lock up capital, lock up assets and provide yield to their investors over a fairly long duration. They also happen to be the only one that got through. And so if you're looking for yield, it was a way to, to get that, at get a pretty attractive yield in a somewhat risk mitigated manner by looking at the real estate as opposed to the operations. I think that's changed. I think that there's been more competition in there, and so you have to kind of look at the pricing of where they're trading at right now and the yields in these private REITs that are being offered. I think with cap rates coming down, there's going to still be a premium to the other sectors, but it's not going to be 2x like it was for some time. In terms of the other question, in terms of should you be looking at diversified? Listen, I think whenever you're investing, you should try to have a diversified approach, which is what we do, which is why we partner. We try to do bigger deals, but bring in partners for them so we can be diversified, but still get the benefit of bigger, better terms from bigger deals, which you can generally get. So listen, I think the real estate's a good way to play it. We also look at other assets as well. But I think, I think the REITs are an interesting way to play it. We'll see what happens if, I think if they're going to need States Act to really get listed. I don't think the Safe Banking Act is going to allow them to get listed on NASDAQ or in New York. So I think that you're still a couple years away from having capital, having more than IIPR as public REITs. So you're really kind of looking at a private investment for the foreseeable future.
Yes.
I just wanted to ask how passage of the Safe Banking Act might change your investment models, and then a follow-up question. I know cultivation is not something that you're looking to any longer, but if you were to give advice to somebody raising funds for cultivation, what are the metrics that you would look at?
Sure. I'll start with cultivation, and maybe we can both talk about safe banking.
Yep.
This is hard. So for an investor, you always have to think about risk return. First of all, you have a limited amount of capital going into cannabis overall. If you have that capital going into cannabis, it is going to be looking for the highest return on that investment because this is a really quote unquote risky business. And so they want the best asymmetric risk that they can get as an investor. So just keep that in mind. If I was going to, if I owned a cultivation business right now and I was going to raise funds, I would do a couple of things. One, I would not try to go and sell anybody who doesn't invest in cultivation. Find the people who, for some reason, already have alignment with this. I imagine it might be people that are in agriculture, and so they want to have some sort of a strategic investment in you. It might be family offices who have done other types of, tobacco farming in particular, or it might also be people who have real estate that they want to figure out how to convert to more of these cultivation centers, and so you're looking for people that might already own those properties. The fallacy in fundraising is that if they've already invested in something similar to what you're doing, then that's not the right target because they've already made their allocation. It's always easier to steal market share than to educate people on why to invest in a market. So that's where I'd start. It's probably not that your metrics are wrong or your valuation's off for fundraising. It's much more likely that you're just not in front of the right people and that you don't have strategic investors in the space. Once you have people who are already beyond just for a dollar amount reason wanting to invest in you, they're going to know the other people who have a similar business-based model on why they want to invest. So we do the same thing. I'm going to a lot of investors right now who are family offices in parallel spaces that have some interest in cannabis, not purely for their monetary return. And that's where we get our highest amount of investors from. Was that the answer to your question?
Yeah. Well, I know a lot of cultivators lack metrics, even their production rate. They don't have those numbers because they're traditionally not business people. So I didn't know if there were any particular.
Yeah, I mean, well, you want to have the very foundation has to be there. So if you aren't actually measuring not only your business metrics, such as we were talking about, your balance sheet, your cash flow, how you actually think your projections are going to finalize, but how production works inside of an agricultural facility, you're probably not going to get anywhere. So I'm baselining that you have all of that. I don't think there's anything fancy that most people aren't doing in that space, except like you said, a lot of people are just saying, this is the market, this is the percentage of the market we think we can win, and thus we're going to be here. And oh, by the way, we're going to be able to, cultivate on X and Y and Z dates, and nobody ever hits their actual deadlines in this industry. So if you can just get those baseline things done, I think you're good. Do you want to talk about safe banking?
Sure, sure. So real quickly on cultivation for us, I think as an equity, I would understand why Codie wouldn't be as excited about cultivation. We actually do like cultivation, we like extraction, we like manufacturing facilities. That's where there's more assets. Yeah. We also find that there's less of an impact on 280E in that part of the process as opposed to the retail, because you can't, there's just a higher OpEx cost, higher personnel costs that you can't deduct. So for us, dispensaries are asset light, and they're the 280, I think, is a little bit harder for us to get our heads around. So we like that, call it the downstream part of the process. On safe banking, listen, I don't think it's going to pass personally, but I think Katrina was actually I thought what she said earlier in the day was pretty insightful, because I think a lot of it is Mitch McConnell, and I've heard the same thing that he's, I heard somebody met with him, said, I'm not sure about that weed thing, was pretty much what the quote that I had heard. So that's my bad Kentucky accent impression. But I don't think it's going to pass. I don't think much is going to get done in Washington between now and the election, positive at least. And I think that even if it does, you're probably not, if it does somehow get through the Senate, you're going to have a bill that's going to look very different than what you have now in the House. So it's hard to kind of say what the impact is. Listen, I think it's good for the industry. I think it would probably be, positive to neutral for my business, having more banking facilities. It doesn't, from what I've read and talked to people, it doesn't mean that the banks are going to be able to start lending, and it doesn't seem, it's not coming off Schedule 1. It's not going to be an industry that people are, all of a sudden going to start pouring capital to. I think you're going to need real legalization through States Act before you can get on the exchanges. That's my understanding of the impact and of the potential for it to pass and the impact on my business. We're following it closely. It's kind of like hard to really figure out, and we kind of, we're trying to be smart about it, but it's hard to really figure out what's going to happen.
And I would just add 30 seconds onto that, which is, I totally agree.
Yeah.
So I live in Washington. I sit on the board of the Marijuana Policy Project and with the Cannabis Trade Federation. For people much smarter than I am on the subject, I would follow the two of them. They pretty much basically guesstimated exactly how many votes the Safe Banking Act would pass in the Congress through the House. That said, if we think about why Trump would pass a bill, he's been pretty honest about it, which is he's a believer in states' rights. So right. Unless the SAFE Act has something in it that looks like it is an allowance for states as opposed to an allowance for marijuana, I think it's unlikely to get fully through. So in speaking with the CTF and with MPP, they've pretty much said the same thing. It looks really unlikely in the Senate. Impeachment's basically derailed any real ability for this act to pass. And on top of that, if it does pass the Senate, the process is kind of interesting. You can go read up on it, but to your point, there's much more likelihood that the Safe Banking Act gets out of the Senate and turns and morphs into a States Act and gets signed, because it will probably look nothing like what it goes through the actual Senate for. And if it does, it might not even get signed because his base does not, unfortunately, they're not big believers in cannabis.
Right. I mean, it's a Democratic issue, and I just don't see the Republicans giving them a win. States Act sponsor was Elizabeth Warren. There's no way that he's getting behind that. So I think it dies until we see what happens in 2020.
Yeah, but I think it's okay, actually. I think we can make a lot of money and do really well as an industry
Yeah.
pre this. And once this all legalizes, our unfair advantage of this industry being capital starved and the institutional players coming in is gone. So we both have to get big enough in this space. You
right.
guys need to get big enough in this space where we're able to create a moat around our business before the big lenders, before the big PE firms, and before the big companies come in to grab up all our market share. So on the other hand, while I don't want people criminalized, I also am not rushing for this thing to be federally legalized because we're too young and I don't think we're all ready.
So on the back of not looking for people to be put into jail, we are looking to take advantage of the opportunity.
That's
So
right.
thank you, Jordan from Reich
pleasure.
Brothers,
Thank you.
Codie from Entourage Effect, and thank you to Cone Resnick for another great event.
Thanks, Scott.
And at this point, we are taking a 10-minute break.